Welcome back. In this video, we will be solving some questions relating to the straight line method of depreciation. So let's begin. Now the first question says a building costs $12,000, right? So this is what the cost is given to us, and that is $12,000. Then it further says that it will be kept for 3 years and then sold for $3,000, right? So what is this 3 years? This is the estimated useful life of this building, right? And then it will be sold for 3,000. This is what the scrap value is also given to us, right? Now the requirement says two things. First of all, we have to calculate the depreciation for each year using straight line method, of course, and it further says that to calculate the net book value of the building at the end of each year. Now what is net book value, right? I'll be explaining you that in a while, but first let's calculate the depreciation. Now since in this question we have three things, we have the cost, then we have the estimated useful life, and we have the scrap value as well, right? So which formula should we use? We'll be using the formula in which first we will deduct the residual value from the cost, the estimated scrap value, and then we'll be dividing it with the estimated useful life, so that we have the depreciation for the current year. So let's begin. Now in this question we have the cost of 12,000 less the estimated residual value, that is 3,000. So it's minus 3,000, and then we'll be dividing it by the number of years, and that is 3, right? So 12,000 minus 3,000 divided by 3 would be 3,000 per year of depreciation should be charged on this building, depreciation per year. In the requirement we are asked to calculate the depreciation for each year, that is for 3 years, for full 3 years using the straight line method. Now what will be the depreciation in the first year? We have just calculated, and that is $3,000. Will it be same for the next 2 years? Yes, the depreciation will be same because we are using the straight line method. So you don't even have to calculate again and again for the next 2 years because it will be same. So depreciation in the first year is 3,000. It will be the same next year as well and the next year as well, right? So depreciation year 1 3,000, year 2 3,000, year 3 3,000, right? So with this we are done with the first requirement of this question. Now the second requirement says to calculate the net book value. Now what is net book value? Net book value is very easy. What is net book value actually? Net book value is the value of the non-current asset that is shown in the final accounts, or let's say in the statement of financial position of your business. In the statement of financial position, both the values are shown, that is the cost of the non-current asset as well as its net book value. But net book value is used to calculate the final value of your non-current assets, right? So how do we arrive at net book value? Net book value is calculated by subtracting the accumulated depreciation from the cost of your non-current assets, right? There is no difficulty in calculating cost, right? This is the purchase price of the non-current asset. But what is the accumulated depreciation? So accumulated depreciation is all the depreciation that is charged, or you say the combined depreciation that is charged on a particular non-current asset from the date of its purchase till the current year. So this is how you arrive at your accumulated depreciation, and when this is subtracted from the cost, you will have the net book value, or the value which is right now of your non-current asset, the current value of the asset, the worth of your asset in the current year, right? Now let's calculate the net book value of this building for each year. So first of all, what is the formula? Cost less the accumulated depreciation. So in the first year we will have the depreciation for the first year only. So cost is 12,000 less the depreciation of year 1, right? This is the depreciation of year 1. So we will have our net book value 12,000 less 3,000 would be 9,000, right? This is the net book value at the end of year 1. Now in year 2, same formula, cost less accumulated depreciation. Now by the end of year 2, our asset, that is our building, has been depreciated by 6,000 in total, not just 3,000. It was for year 1 only. So 12,000 less 3,000, which was of the first year, right? Again first year, and then again less 3,000 for the next year, and that is for the year 2. So in total 12,000 less 6,000. So right now our asset is standing at 6,000, right? Of course it is decreasing because of the increase in depreciation every year. In first year it was 9,000, now in the second year it is 6,000, right? Now let's do for year 3. How will we do for year 3? First of all, cost less 3,000 for year 1, then again less 3,000 for year 2, and then again less 3,000 for year 3, right? That is why it is called accumulated. You are accumulating depreciation from the date of its purchase till the current year, right? So by the end of year 3 our asset has been further depreciated by this 3,000. That is why the accumulated depreciation is 3 plus 3 plus 3, it is 9,000 right now. So our net book value, the net book value of this building at the end of year 3 is $3,000, right? And this is what? This is the same value which the business estimated at the time of purchase, that this value might be recovered at the end of its useful life. So this is the scrap value. This is the value which we subtracted, right, in the beginning when we were calculating depreciation. Okay, so this is how we calculate the net book value. It is very simple, just cost less the accumulated depreciation from the year of purchase till the current year, and then we'll have our net book values. Now let's move to the second example. Second example says a business buys fixtures costing $800. So the cost is given to us, and that is $800. Cost is $800. Then it says that they will be kept for 5 years in the business. Okay, so this is what? This is the life, the estimated life is given to us, and then scrapped. And then scrapped means no value is given to us, so this means that the scrap value is 0, right? The business is expecting to not receive anything from the sale of these fixtures. Okay. Now first requirement again is to calculate depreciation for each year using straight line method, and then net book value of the fixtures at the end of each year as well. Very good. And the life is 5 years. So should I again use the same formula, and that is cost less residual value divided by estimated useful life? No, because the residual value or the scrap value is not given to us in this question, and that is 0. So we will simply be using the formula cost divided by the estimated useful life. And in this question the cost is 800 divided by the estimated useful life of 5 years will give me a depreciation charge every year of $160, right? This is the depreciation per year or every year, right? And this will remain same for every year till 5 years, right? So depreciation in year 1 till year 5 will be same, that is 160, 160, 160 for full 5 years. Okay, so we are done with the first requirement, and that was to calculate depreciation for each year. Now the second requirement is to calculate the net book value of the fixtures at the end of each year as well, right? So again, how we can find this? Net book value is the cost less the accumulated depreciation. So in year 1, 800 less 160, that is the depreciation charge for the first year only. So that would be 640, right? We are done with this. Now standing in year 2, we have to subtract two depreciations, 160 and 160. So that would be 160 plus 160 is equals to 800 less 160 plus 160, that is 320. So that would be 480, right? Now we are done with 2 years. In year 3 again 800 less 160 plus 160 plus 160 for 3 years. Now these 3 years, and that would be 320. Then for 4 years 160, 160, 160, 160 for 4 years, right? So 800 less 160, you can multiply it by 4 or just write 160 4 times. So that would be $160 of course. And in year 5, so 800 less 160 5 times now, or just 160 multiplied by 5. So that this is 800 and this is also 800. So this means that the net book value is 0 at the end of its useful life. Why is it 0? because we estimated in the first year, in the year of purchase of these fixtures, that we might not receive anything on its disposal, that is they were scrapped, right? Nothing is received from these. So that is why net book value at the end of its useful life is 0. Now there's another way to calculate net book value in order to avoid these many calculations, and that is a simpler way. So let's do that as well. First you write the cost. In this question the cost is $800, right, of these fixtures. Then you have to subtract the depreciation in order to arrive at the net book value. So depreciation every year is $160, right? 800 minus 160 would be 640, and this is what? This is the net book value for year 1. Now we have to carry this calculation till year 5, right? So this is the net book value at the end of year 1. Now what you have to write is you now have to subtract the depreciation for year 2, and that will also be $160, right? So now 640 less 160 would be 480, and this is the net book value at the end of year 2, right? 480, right? You can check it from here as well. 480. Now why is that? How is it 480 coming? Because we already subtracted this 160. Now we just have to subtract the 160 of the second year from the net book value of first year. That was already 160 was subtracted from this cost. So this is a simpler method. Now we have the net book value for year 2. Now you just have to subtract the depreciation for year 3, and that would be again 160. So we will be at the net book value for year 3, and that would be $320, right, for year 3. So yes, $320. Then depreciation for year 4 would be again $160, and 320 less 160 would be of course $160. This is the net book value at the end of year 4. Lastly, depreciation for year 5 would again be $160, and then we will have a net book value of 0 at the end of year 5. Right, so this is a more simpler way to calculate net book values at the end of every year, that is by subtracting the current year's depreciation only from the net book values. Now let's move to our last example, which says a printer costing $100,000 is to be depreciated at 25% per annum, that is per year, using the straight line method. Now we are asked, what are we asked? Calculate the net book value at the end of year 3 only. Okay, calculate the net book value at the end of year 3. Now what is given to us in this requirement, in this question? We are given with the cost $100,000, and we are given with the percentage rate. We don't have the useful life, we don't have the residual value, we just have two things, cost and the percentage rate. Now which formula can we use to calculate depreciation every year? That is cost multiplied by the percentage rate. In this question we have the cost at $100,000 and the percentage rate is 25%. So $100,000 multiplied by 25% would be $25,000 of depreciation every year. This much of depreciation should be charged in the income statement against this printer, right? Okay, now what are we asked? We are asked to calculate the net book value at the end of year 3. Okay, so we have just learned a way to calculate net book value, and this is a very simple way, right? Now we can use this method. First of all, what is the cost? The cost is $100,000. Year 1 depreciation is $25,000, right? So let's subtract that so that we have a net book value at the end of year 1, and that would be $75,000, right? Now for year 2 depreciation, we will again subtract the same value, and that is $25,000, same depreciation, so that we have the net book value at the end of year 2 standing at $50,000. Right, we are asked to calculate the net book value at the end of year 3. So for year 3, again year 3 depreciation would be same $25,000, and then from 50,000, when I subtract 25,000, I will be arriving at the net book value at the end of year 3, that would be $25,000, right? So the net book value of my printer at the end of year 3 is $25,000. So this is how we calculate the depreciation using straight line method and the net book values at the end of every year. So that's it for this video. Please don't forget to subscribe the channel, the accounts, and hit the bell icon as well so that you don't miss out on any important videos. See you in the next video.